Welcome to another edition of Inside the Economy. I'm Larry Howes. Thanks for joining me. Talk about the mortgage market, what's going on in the bond market, some cash, which is kind of an interesting feature this late in the year, and some questions about China. Quick look at the numbers. What we have here is beginnings of some excitement in the jobless market, which isn't very much. You'd think there'd be a lot more jobless with some hurricanes and Boeing strikes, so on and so forth. It went up a teeny tiny bit, came right back down. Job market is very strong. Unemployment is still at 4.1, not bad, especially at this part of an inflation cycle. Oil is down. Bond yields are up, meaning the bonds sold off because there's a lot of drama going on in the interest rate market that we'll talk about here, and mortgages are creeping back up. What we have here, and you look at the United States, and the darker the color here, the better the job growth. The United States is not doing poorly creating new jobs. They're doing very well in some places not so well, but for the most part, it's expanding pretty well. If you're looking for a job, you can find it. Unemployment, even with some of the issues in the calculation, is still 4.1, and it's showing no signs of increasing. There were some predictions that was going to be a real bad number by election time. No. Mortgage rates, and this is only a week old, were coming down, just above 6 a little while ago, 6.18 for a while. Took a week for that to back up. We're bumping up at 7 right now. The bond market adjusted because the happy days of the half a point rate cut didn't last very long. It was too much too fast. Everybody got excited thinking we were going to go back down to 0 again, and no, we're not. So the market adjusted. We're back at a more rational point right now. We'll get a quarter point reduction in November. That's a week or so away, and probably another one in December. So what was always a reasonable target, meaning a 1 point reduction, bringing the cost of money down to about 4 by year end, well, we're on track for that. What happens after that, that'll be a different discussion after we see what Congress and who's in the White House. Home sales were viewed as, lack of supply, they're way down, so on and so forth. Actually, what home sales are doing are normalizing back down to where they should be. And this goes back to the 90s, which was a rational market. And we're getting back down there now. If you have a reasonable home and reasonable income, there are transactions. There just isn't a huge inventory like there used to be. It's no secret that middle-class America is having trouble with the home market, especially if you're trying to do a new household formation. And this came from the Home Mortgage Disclosure Act, that they picked out Las Vegas and Henderson as being especially tough on middle class. But what we have here is a report out of Fannie Mae, and they put these out every now and then, that housing is not affordable right now. In fact, record low housing affordability on the charts is it's not affordable at all. So they put out some calculations that said one of these three things, or some combination of them, will bring it back to what Fannie Mae viewed as a very nice home market, meaning 2016 to 19. Money was basically free. There was lots of homes, and not too high a price. So right now what we have to do is the median price of a single-family home would have to drop 38%, or median household income would have to rise more than 60%, or a 30-year conventional mortgage would have to fall to down around 2.35. I don't think any of those are rational or likely, but it's going to be a political football regardless of who's in the White House. And it's going to be what Congress feels like they think they can help. Unfortunately, where we have a rational house market is basically price of a house is 4 times median income. Well, right now it's 6 times, and I don't see that changing in the near future. S&P 500, you look at the underlying assets of things, a lot of very long contracts, meaning people are buying into the S&P 500 for more than 2 years, more than 3 years, and buying futures along those lines. They have confidence in the S&P 500, and there's not a lot of bubbles showing up. People are really following assets based on earnings. And here's, the Dow and how we track these three markets and NASDAQ. They're kind of going sideways, very sensitive to changes in earnings, quick drops, quick recoveries. This is not bad news either. This is not indicative of a bubble in the equity market. In fact, worldwide, more money again, about 150 billion has already gone into ETFs, U.S. equity ETFs from Asia and Europe in 2020, just in 2024. We're the only game in town. This morning, Volkswagen announced they're going to probably close 3 plants in Germany. Frantically bad news if you're in a union or for Germany, because they're losing, a huge piece of their manufacturing advantage. They just don't have the sales, especially in China. United States is not suffering either. We have, it's very likely this is money markets. This is about $6.5 trillion in money markets. We're probably going to see $7 trillion before the first quarter next year, regardless of the political outcome. A lot of money. Cash in banks, individuals, about $3.5 trillion. This is not an environment where people worry a lot. In fact, this is an environment where these people don't mind keeping interest rates high. They get good, idiot-proof, consistent interest payments through federal spending. And they're in no hurry to have interest rates start coming back down. They don't need money. They don't need to borrow money. Kind of a change in psychology. The other side of the coin here is, there's some questions about China, thinking, are they making a comeback? And I'll answer that with this one. It's about China's youth, that very important 16 to 24-year-old youth demographic. It was at 20% unemployment here not too long ago, and then they pulled the series out of their own version of reporting, took all the college students out. If you understand the college system in China, it's not like they're gone forever in residence. But anyway, they pulled all the college students out, dropped back down, and they're rising again. When you have a demographic problem like this and a population that was not only declining, they've started to decline precipitously now, just like the Japanese. So this is a very, very important demographic for them, which isn't doing real well. So if you're ambitious or have brains in China, you have to look elsewhere. Canada is not the place anymore. They got their own problems. So Indonesia, Singapore, wherever they can. Unfortunately, this also brings to light another issue in China, basically the whole debt thing. You're getting up here in system-wide leverage. I love that term, system-wide debt. Very similar to where we are in the United States, not dissimilar at all. The difference is U.S. has consumers and had a lot more money, a lot more cash, a lot more everything. This is a group that doesn't have great long-term prospects, and federal spending on stimulus projects for bridges and whatnot isn't going to be enough if you haven't got a consumer and you haven't got confidence in where your economy's going. So, well, here we are. We have very few problems. We got to resolve some things with an election that won't resolve anything. And happy to deal with some of these questions. Just send them along to info@shjwealthadvisors.com. And thanks for joining me. I'll see you next time.